forecast for India and Chinese GDP growth. Marie Diron, the Associate Managing Director, Sovereign Risk Group, Moody's Investors, has joined us. Good morning, Marie. Well, first up, you have given us this 7.5% GDP growth for FY17. I assume it is for the year that has just ended on March 31st. Did you take into account the fact that there is a new industrial output series and a new wholesale price index series?
So these new data are not yet factored in our forecast. I think they are likely to, the data revisions are likely to really lead to changes throughout, not only for this year, but also in history. And in this case, what we are really most focused on are really the trends in growth. So what we are seeing in India is stable growth at robust levels, and we do not expect that to change with the revision to the data series.
Okay. Marie, good morning. So stable as far as growth is concerned. I wanted your views on inflation as well, because you've projected inflation to rise to 5% by the end of this year. But what we now have is a projection of a normal monsoon situation. So do you think inflation could even surprise, perhaps get to even just 4% by the end of the year?
There are risks both on the downside and the upside to our inflation forecast. What we take into account is really the effects of the fact that the lower energy price inflation of last year is fading off, and that leads to a rise in headline inflation. We do not see at this point really significant inflationary pressures. So we would really consider that inflation rate to be moderate. We could be surprised on the downside, indeed, with a good monsoon having an impact on food prices. Okay. It could also be that the relatively robust growth that we are seeing does put a bit of inflationary pressures in some sectors.
Okay. Well, actually, I wanted to have one more question on sovereign risk rating, Marie. The argument really is that you're forecasting a 6.5%, 6.6% growth for China, and at least 100 basis points higher for India at 7.7%. Plus, if you took the shadow NBFC debt of China, the debt burden is really high in that country. And yet there is a vast rating gap between what China gets, which is, A and thereabouts, in India at BBB plus. Why this kind of a chasm? Do you see a rating upgrade for India?
So our sovereign ratings really consider a wide range of factors, and the growth rate is one, really, as an indication of really the robustness of the economy and the extent to which the government can rely on the economy as a source of revenues. And in both cases, for China and India, growth is high by any standards, really. So that's supportive to the ratings. Where India and China differ are in various ways. One is that income levels in China are somewhat higher than in India, and that again points towards some shock absorption capacity in the economy, maybe to a greater extent. You're right that we do see higher debt in the economy as a whole in China. At the same time, it is also supportive to the rating, to China's rating, that the government is able to control parts of the economy, parts of the financial system, and can rely on very large savings and very large foreign exchange reserves to finance that debt and to really mitigate any financial stability risk. So a range of factors here. Okay. As far as India is concerned, we have a positive outlook that denotes some positive pressure on the rating, really on the basis of the reforms that we are seeing be implemented at the moment in India. And that's really a key focus for us.
Okay, Marie, we'll leave it at that. Thank you very much.